The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. Now, as we continue to see the increasing impact of climate change on global industries, the role of corporate responsibility in addressing environmental challenges has become more critical than ever. Now, the Paris Climate Agreement and frameworks like the Science-Based Targets Initiative have set ambitious goals for companies worldwide. But recent events, such as high-profile companies scaling back or withdrawing their climate commitments, have raised important questions about the future of corporate climate leadership. So what does this mean for investors? Should investors be worried about waning corporate climate commitments? Well, to find out more, joining me now is Mervyn Tang, who is the head of sustainability of APAC at Schroders. Mervyn, welcome to the show.
Hi, Hongbin. Really glad to be here.
Really glad to have you on. Mervyn, several high-profile companies have withdrawn from or scaled back their climate commitments, and this is including Volvo, Air New Zealand, and Shell. How do you interpret the retreat from climate commitments by these companies? Does this signal a lack of genuine corporate climate leadership? Is the climate leadership theme waning?
I wouldn't quite put it like that. I think it's a reflection of how difficult it is to decarbonize, because I think we've seen lots and lots of companies out there. I think more than 2,000 companies signed up for the SBTI, Science-Based Target Initiative, setting net zero targets for something like 2050 or interim targets for in between. And I think after setting targets, I think companies have started to think about what does it actually take to implement these targets, and what other factors might evolve that could affect our ability to deliver them. And not everything is in a company's control. So if we take the Volvo example, they committed to producing just electric cars by 2030. I think in reality, though, what we saw in the economic environment and government support is that rolling out of EV infrastructure was a bit slower than expected. Customer demand was not at the pace in terms of trying to buy EVs as much as it would take for Volvo to actually meet that commitment. And so I think as companies start to understand the economic conditions, they are managing that to the targets that they previously set. But I think this is very different to a pullback from targets, right? It's just realizing some of the economic realities. I mean, the same can be said for, I think, Air New Zealand. When they kind of cut back on their 2030 commitments, I think they realized that actually with the supply chain issues that many industries, not just airline space, the delivery of fuel efficient planes was slower than expected. So their ability to reduce emissions were affected by outside factors. So I don't think that's necessarily a retreat of climate leadership. It's just we are operating in a complex environment.
I see. So since we're seeing this kind of pullback from targets, how should investors then interpret this retreat from the climate theme?
I think we, as investors, and I think this is where it becomes important to analyze these issues in a thoughtful way, is that it's targets and not invested in companies without targets really fully tell the story. When we look at, let's say, companies that have set targets and then have since pulled back, we need to understand why. And is it, as you said, is it a failure of climate leadership, or is it a retreating of climate leadership, or is it a reflection of business realities? Is it a reflection of policies? And that requires things like comparing companies and how they're approaching decarbonization relative to their peers. Is their inability to decarbonize a function of the fact that they're operating in an emerging market economy where there is more carbon intensive energy supply? Or is it that they're just not putting the necessary money into investments for decarbonization technologies that would eventually put them in a negative position relative to peers? And it's not going to be easy as just comparing data metrics and basic data. I think as investors, we really need to dig deep to understand what's going on and why companies may be struggling to decarbonize.
I see. Then should investors who are invested in this, whole climate change theme, should they be worried about this, or should they, continue to stay invested?
I think we need to, I would say maybe two things there. I think the challenges to decarbonize, I think, is important for investors to understand, in part because I think at Schroders, we believe that companies that are better positioned to decarbonize, that are leaders in this space, will be able to handle the economic transition better. And so from a risk management perspective and understanding the resilience of companies, it is very important to understand which companies to invest in. But that's very different to pulling away from the climate investment theme as a whole. The other thing I would say is we also need to look at not just climate commitments, but what's been happening with the change in the overall space. So if I give you an example, in 2022, China added 80 gigawatts of solar capacity. That jumped to 220 gigawatts in 2023, up to 270 gigawatts in 2024. China is installing solar capacity at an incredible rate. Wind has also been increasing, although not quite at the same speed. And so it's not like we're seeing renewable energy generation pulling back. We're actually seeing huge increase, particularly in China. And so that can bring a whole range of opportunities for investors to take advantage of. So yes, decarbonisation will be hard. There's still going to be demand for fossil fuel products, but we're also seeing great opportunities in the market.
I see. So what are the risks then for those with exposure to this climate investment theme? What are the key climate-related risks investors should be aware of when evaluating a company's future prospects?
Yeah, it's one thing that I often talk to investors interested in this space is that climate policy and climate change is not happening in isolation. Because I imagine when you kind of talk with others outside of sustainability and climate space, you've been probably talking about higher interest rates, you've been talking about inflation, you've been talking about supply chain dynamic issues. And all of these things has had an impact on how quickly renewable energy has been installed, how quickly we're installing renewable energy infrastructure, how quickly we're installing EVs. Just give you, I think, examples. Higher interest rates has led to, I think, given a lot of climate technology companies may have low margins, weaker cash flows, many struggled with the pressures of high interest rates. When we talk about the kind of installation of infrastructure, when the transportation of EVs, a lot of key supplies in terms of metals, EV parts, were affected by what has been happening in Russia, Ukraine, Israel, Palestine, which affected some of the stocks that you might be invested in when it's coming to climate technology. So there's a lot of macroeconomic factors that is affecting kind of an investment in climate theme. But I think that's really kind of where it becomes important not to just think of climate theme as let's just invest in anything that's climate. Let's just invest in renewable. Let's just invest in green. Let's just invest in infrastructure. It becomes important to understand the industry dynamics involved, which industries and which companies within those industries have a strong competitive position. They're able to take advantage of increases in things like wind and solar capacity in China, and then really carefully and actively think about which companies to invest in. I mean, that's really kind of where the role of active investment managers play a key part.
I see. So how can investors, track and measure a company's progress toward, meeting its climate targets then? What metrics or frameworks should they rely on?
Yeah, it can be a bit of a Pandora's box that you can go down. I think so we take the SBTi, I mentioned 2,000 companies had signed up for this. We saw 200 companies have their SBTi targets withdrawn. So from a very kind of high level basis, I think initiatives like the SBTi can give an indication of whether the targets are in the process of or are progressing in a way that is likely to be met. But of course, that's only going to be a certain amount of companies. So how can you preempt that as investors? And I mean, that's when you start to need to look deeper. So there is a lack of company disclosure to look at this in detail at the moment, but we're starting to see more companies indicate what capital expenditure they're investing in to be able to decarbonize. If I'm a steel company, if I'm a steel manufacturer, am I trying to electrify my furnaces and production facilities? If I am a tech company, the Googles, the Metas of the world, am I investing in data centers and then are those data centers being linked to renewable energy or using renewable energy? So we're getting more and more information to be able to understand which companies are actually putting the efforts and steps to decarbonize and which companies are not. I think, of course, it's hard to, let's say, the average individual household or retail investor to look at all this information. But luckily, I think there's many asset managers as well as data providers which are using this information to come up with opinion and analysis.
I see. Well, given the growing interest in ESG, then is there a way that investors can avoid companies that, may only be engaging in so-called climate signaling without real action behind their climate goals?
Yeah, it is. And I think this kind of goes into the complexity of it. I think if, let's say, investors were investing in asset vehicles, it's very difficult to do that, to get all the nuances, right? So you can invest in companies that might have decarbonized by a certain amount over the last 2-3 years. You may be able to filter out companies that have targets versus don't have targets. But it's very hard to make an assessment of which companies are not going to be, which companies are likely to not meet their targets in the future, looking at kind of data metrics alone. So I would say actually it becomes very important to then, I think, to understand the story of the company, understanding why and how they decarbonize and what's really going on. I would also add, I think it becomes quite important when we're looking at differences in carbon emissions of companies is quite often it may be, if you're comparing companies within the same sector, a reflection of the business model. So if I am a nickel miner, I'm going to pretty much most likely have a higher carbon intensity than purely if I'm an aluminium ore, if I was a miner for aluminium ore, just because the process is much more carbon intensive. And so if I'm an investor, I don't want to not invest in a nickel company, particularly with nickel being an important battery technology, just because the carbon number is higher. And so I think, again, it's not easy, but I think it requires an analysis of what's really going on under the bonnet of the companies.
I see. So how can investors assess the long-term viability of a company's climate commitments then, especially when faced with uncertainties in regulatory environments or technological challenges?
So I think one developing innovation, one that's getting more sophisticated, is that there's a lot of focus in the world corporate transition plans. So instead of companies just setting a target, there's now increasing expectations from investors, regulations, that they create a plan outlining what they're going to do, outlining the business implications, and outlining, importantly, the technological and policy and economic assumptions that underpin them. So, and it gives you a kind of example, Singapore Sustainable Finance Association has been very focused on working with financial institutions as well as companies to be able to create these transition plans that are credible and be able to understand and evaluate a company's long-term trajectory. It is, if we go back to a New Zealand example, one of the challenges with that target was that they were hoping that sustainable aviation fuel would become much cheaper at a much faster rate for them to be able to use that as a lever to decarbonize. Unfortunately, I think for multiple reasons, the pace of adoption and the cost of sustainable aviation fuel has not come down as much as they would like to be able to achieve the target that they would like. And so it is going to be these technological economic assumptions that will give us an indication of whether a company's target are likely to be able to be met in the future.
I see. So how should investors then balance the potential opportunities from companies leading the transition to a low carbon economy with the risks posed by those that may struggle or retreat from their climate commitments?
I think that question really highlights the need to monitor, because things are changing every day. The economic environment, the policy environment, even technologies are going to be constantly changing. And so the path that a company thinks it will decarbonize, a path that the investors expected a company to go through to decarbonize, are going to have external factors as well as internal company decisions that's going to change that pathway. We're not even I think a lot of companies have kind of hoped for a linear decarbonization, right? If we set net zero by 2050, we'll reduce emissions 50% halfway through and then do 100% by 2050. It's not going to happen like that. It's going to be that the pace is going to be changing, and our best guess on whether a company is able to meet a target or their likely decarbonisation pathway is going to be changing over time. And so I think it's something that we have to just roll with the punches, look at what's happening, rather than being able to make a decision now and be able to say these companies are automatically the ones that are going to be decarbonising and going to net zero by 2050.
I see. And before we let you go here, Mervyn, moving forward, how can investors still have exposure to this climate theme then? I mean, what are the opportunities that are still available despite such waning corporate climate commitments?
Yeah, I would maybe say two things that I think investors should think of. I think there have been challenges when it comes to the pace of decarbonisation, the sales of EVs, the installation of infrastructure. However, I think at the same time, as I mentioned, in China, renewable energy, wind and solar has been increasing very, very quickly, right? That doesn't mean that investing in a solar panel producer or a wind turbine producer is going to make you money, because there are industry dynamics that have margin and cost pressure in those industries. However, one area, like if we do see wind and wind and solar energy increasing at this pace, is that the private asset space, direct investment in infrastructure, that asset class is going to be expanding just by the sheer volume of capacity being installed. And that gives an opportunity to investors to be exposed as more and more private assets become accessible to the wider market. The other bit that I think investors may want to consider is, so the decarbonisation is one way that the world is trying to mitigate the effects of climate change. And so they're trying to limit how much climate change we face in the future. The other word that's often used is climate change adaptation. So the fact that if we know sea levels are going to rise, hurricanes are going to become more severe and frequent, that we know that the temperature is going to be increasing, what can we do to adapt? And that's going to also have investment opportunities. That might be agriculture technology that will be able to improve crop yields in hotter environments, or environments that might be more susceptible to extreme weather. It could be flood protection and early warning mechanisms that countries are going to be badly needing to be able to handle the increases in natural disaster. I think we look at some of the devastating wildfires happening all across the world. Governments and other institutions are going to be spending much more money on how we're going to prevent this. And so climate adaptation, because we know climate change, even if we get to net zero by 2050, we're going to have physical climate changes. Right. Adaptation is going to be an important opportunity as well for investors.
I see. Well, thank you so much, Mervyn, for your time and your insights today.
Fantastic. Happy to be here.
Thank you. That was Mervyn Tang, who is the head of sustainability of APAC at Schroders. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.